Welcome, ladies and gentlemen, to another day in the stock market. The stock market is down around 0.5% today, even though we had good economic data come out of the US, with quarter-on-quarter GDP being higher than expected and jobless claims being lower than expected. So what is going on? Should you be worried? Well, we'll discuss those things today. So let's get straight into it. Let's take a look at the economic data that came out of the US just a few hours ago. Now, as you can see here, today we had durable goods orders come out at 2.9%, higher than the expected drop of 0.5%. That is important. And the next thing to look at is the growth rate, the GDP growth rate, quarter-on-quarter final, coming in at 3.8%, higher than the expected 3.3%. Now, these two things are important because it shows that the US economy may be growing faster than expected. Now, let's look down here at initial jobless claims, which came in at 218,000, lower than the 235,000 expected and lower than 232,000 from the previous reading. So what is going on? Well, what we need to understand is how these numbers affect projections for interest rates in the future. And just to give you an indication, take a look at this. And just so you can see it properly, let me zoom in. Now, what you can see here is the interest rate expectations or probabilities for the October meeting, for the 29th of October. At the moment, there is an 83.4% chance that interest rates will drop by another 25 basis points. But here's what you need to understand. Take a look at the estimate 1 day ago. It was at 91.9%. So we've had a drop of 7% in just 1 day, in this expectation that the Federal Reserve will drop interest rates by another 0.25%. Now, why is that important? Well, when interest rates go down, that means businesses can take out loans at a cheaper rate. It means consumers can get mortgages at a cheaper rate. They can get car loans at a cheaper rate and so on. That can create economic growth. What it also does is allow for cheaper money printing as well, because with a lower interest rate, then the payments on the US debt can go down. However, if you get strong economic data, then it is less likely the Fed is going to reduce interest rates. Now, here's why the initial jobless claims reading is so important. You see, just this week, the Fed reduced interest rates to, by 0.25%. That is important. It's the first time they've done it this year. And what Jerome Powell cited was the destruction of jobs, right? Was the job market going into decline with initial jobless claims going up quite quickly. So with jobless claims now suddenly going down, it leaves people wondering, are they doing the right thing by decreasing interest rates? And are interest rate decreases going to come in the future? Or are interest rates going to be held at around 4% for the foreseeable future, especially if the economy remains strong? So if you keep interest rates where they are, it means borrowing costs are higher. And that is why we're seeing, and let me show you now, we saw this decline in the Nasdaq 100, where it opened today at 24,500, and the lowest it got to was 24,200. We're now hovering in between at around 24,400 or thereabouts. And the S&P 500 is also down 0.5%. You can see here it opened lower than where it closed last night. Now that is interesting to understand because it shows how valuations can be affected by higher interest rates. What I want to show you is this. The durable goods orders So this is something to keep in mind. Although on the face of it, the economic data looks good, part of the increase in this durable goods orders of 2.9% is actually probably down to higher prices because of the tariffs, rather than increased volumes, increased sales, or increased orders. And that is a concern, because we might actually see a decrease, or we might have a decrease in durable goods orders, but if the prices are rising so fast, these numbers can make it seem like that there are more orders than there are. And that is a problem, because you might look at this and think the economy is doing well, it is clearly growing, companies are ordering more. But actually, no, their costs are just higher. And that is why it looks like they're ordering more, when in reality they might not be. Now, that could also be said for GDP as well. With GDP, there was a revision for services spending at 2.6%, and spending on goods at 2.2%. Once again, these two could both be affected by the increased costs of tariffs. And that could be a problem, because it might be hiding what is going on. However, what you're also seeing is that initial jobless claims are coming down. Initial jobless claims in the US sank by 14,000 from the previous week to 218,000. Even though the consensus was that jobless claims would go up to 235,000. So this marks the lowest figure in 2 months. And like I said, this was the reason, jobless claims getting worse was the reasons why the Fed restarted its cutting cycle, even though there is still high inflation. So now you're left with this conundrum of the Fed potentially being forced to stop its rate cutting cycle, abruptly, allow inflation to keep going higher, which it may do due to the tariffs. And if the economy is actually robust and does hold strong, then the Fed doesn't have the numbers, the data to back it up, to give it the push to actually reduce interest rates. If we're getting low jobless claims numbers, and that is what the Fed is looking at, they want strong employment, then what reason do they have to reduce interest rates? And in the short term, that could be a problem for company valuations. We might see a contraction in them. That is why we're seeing a decrease in the Nasdaq 100 right now. That doesn't mean there will necessarily be a crash. We might get a correction of a couple more percent. There might be a bigger correction. We just don't know. But if the economy is actually strong, then there is a good chance that over the next few months, stock prices will continue going higher. But we just don't know at this point. In fact, the data right now is very confusing. Just a few weeks ago, we saw unemployment claims being revised much higher than we initially thought. But now we're seeing lower unemployment claims. So the data is a bit confusing. However, in my opinion, there's no reason to panic yet, because clearly, even if the economy is in decline, it is still growing, albeit slightly slower than it may have been doing last year. And so unless we get to a stage where the economy starts to rapidly decline, where we know we are probably heading into a contraction, that is when we will see a large correction in the markets, or even a bear market. But right now, I don't think that's the case. I just think we're seeing a very healthy correction, and before we know it, we'll be back at all-time highs. At least that is my opinion on this matter. So, thank you for watching, and I will see you on the next one.